But now let's get straight into today's market action. Joining us now are Charlie Bobrinskoy from Ariel Investments and Scott Chronert from Citi. Scott, let me start with you on this one. So we've got Apple at $2.75 trillion market cap. NVIDIA has more than doubled year to date. Microsoft is up near its highs. Is all of this sustainable given, I know soft landing looks like a strong possibility to everybody, but there are still some challenges heading into the back of the year as we're seeing in a lot of these earnings reports?
Well, I think there's certainly two elements to this, right? So number one, the growth leadership of the S&P is pretty clear. We think it accounts for nearly all of the move year to date. And it's mostly a multiple expansion move, okay, much more so than an earnings move. So that keeps us focused on interest rates. And the view that ultimately we get to a peaking Fed certainly is a tailwind for mega cap growth in tech. On the other hand, I think we also have to be aware that AI is becoming part of the equation here. And I think part of the mean reversion trade in the tech and related is positioning for some of that. Along the way, we know that not much has flowed into the equity markets from the financial advisor world. We see this in our ETF data. So we do think there's room for a catch-up, but we're also of the view that 4,200 is pretty close to capping what we would say a high end of the trading range.
Yeah, and of course, as the markets do settle here, 4198 is what it looks like the final number is, closing number for the S&P 500. Charlie, want to get your thoughts on this. We keep talking about this narrow trading range. Most likely next direction for the S&P, higher or lower?
Always hard to make a short-term call, but I do think there was unnatural fear of a debt default, which I don't think is going to happen. And when that gets cleared up, that's going to be a positive. You think everybody must know that, but look at what happened yesterday to cyclical stocks when we got some good news on the debt ceiling. So I think, frankly, the other way to make this prediction is that people are still very nervous. People still think we've got a recession coming. There's a lot of negativity when growth tech and growth stocks are leading the market. That's a sign people are worried about a recession. And so that makes us confident that when everybody is this negative, it's a good time to be in the market.
I do want to mention Applied Materials and Ross Stores results, both crossing the tape. We are going through those as we speak. But Charlie, to you again on this one, given that a lot of this run higher has been valuation driven, what do you have to believe to invest in these stocks at this point? How long a time horizon do you have to have, and how much is belt tightening having to factor into that?
Yeah, I always make a distinction here between the market, which people rightly quote the S&P 500, which is so strong, and the individual stocks, which many of which are not strong. The Russell 1000 Value Index is basically down on the year, trading at extremely reasonable multiples of around 13 times. So in order to own value stocks, you don't have to believe much at all. You just have to believe we're not going into a crushing recession. To own the NASDAQ, to own the biggest tech stocks, you've got to believe a lot. And frankly, you've got to believe that interest rates are going to stay down at a lower level, because with higher interest rates, we know those tech and growth stocks get hurt. And then frankly, those stocks have been where people have gone to be defensive. People have gone into Amazon and Google because they think they won't be as hit hard by a recession. And so if we get a good economy, I think the value is going to outperform, although I've said that for a while.